I thought for a long time that we should do some reviews of books because we can't always get the speakers, and also it allows us to take a little more leisurely approach to things. So I just want to partly also use it as a lever to get some discussion on some points that I think are either excellent or good, or perhaps not so, are more controversial. And so that's his latest book. Has everybody got the notion that the variance premium is the volatility premium, the same thing? Let me just say, namely the excess that you can hope to harvest from overpriced premiums. A variance swap is that difference. It's the difference between the current, I think, implied volatility or volatility, and what is realized. And you're looking for, are the predicted volatility at a future date. A skew swap would be a swap of skews. One of the that's just terminology. I don't think I'll dwell on it. Some people are going to get it, some aren't, and that's just as it is. And one really interesting point, people were talking about VIX briefly, and these are points in his book that I'm just suggesting. Struck me as interesting. If you disagree with them, please just say so, or whatever. One of the very interesting points that I thought that I learned from the book was that VIX. The question comes: the spot VIX, which is an implied number, it's not a tradable number, is usually different than even the nearest future. The nearest future is higher. And as they converge, you get a lot of convergence splashing around as the next future month moves into the present. And which of those is right, the future or the spot? Now, let me see, which did he say was right? I think he said that the spot, I'm pretty sure he said the spot, that the present value of the VIX is right. So there's a real possibility there as that VIX comes down from the into the present to do some trades with that. And he said, we have the question, if you look at, if you're selling some out of the money puts, which is really the engine of profit in a lot of the trading we do, selling puts, and where is that advantage that we're hoping to harvest coming from? He says half of it is from the skew and half of it is just from the variance. So that's another interesting fact. Another point that I found very interesting in his book was he looks at the variance premium. We know it exists for stocks, or rather for indexes, even better. Does it also exist for commodities? Yes, it does, he finds. And he found that in his studies and his references that natural gas had a 10% nice high premium. S&P 500, I get the impression it's around 4 or 5. And then we find that some of these commodities, crude oil, heating oil, SB is sugar and corn, had a good, at least decent size, reasonable sized variance premiums, excesses of prices of stocks, of options on these commodities that could be harvested. And also he has correlations there. The grains being the least correlated with the S&P. And the reason you like that, you want small degree of correlation, is for diversification, reduction of risk. So this holds out a lot of promise to my mind, and for diversifying our trading. We do too much of it in stock indexes, the S&P. We need to do it also in other underlyings. One interesting thing that you'll find in his book is he states what trading strategies he trades as the core of his portfolio, and those he calls the highest confidence trading systems. And this is what is listed in the book. And he lists VIX options. He says sell them if it's in contango, buy them in backwardation. And he has a whole thing about factor-based investing. In other words, he's looking to buy calls or sell puts on low PE stocks, on high price to book stocks. And I have the list there. So you'll find that the details at somewhat great length in his book. After positive earnings by a call spread. So he gets into some of these earnings trades. Has anyone experimented with factor-based investing in options trading?
Don, I didn't read the book, but the factor-based investing seems kind of out of left field for this guy. Where's the volatility play in that?
Well, he actually has studies for each of these that show that it isn't a volatility play, I think.
Yeah, exactly. It's a separate way of investing.
Mm-hmm.
Oh, yeah. Great. Okay.
I guess he's talking about diversifying beyond pure volatility plays.
Yeah. So I remember he mentioned risk premium as well, which equities would fall under. So,
yes,
but then when it comes down to saying how do you do that, then he's suggesting that using factor-based investing can help you get on that train, right? In terms of the selection of the specific stocks by using factors to help you isolate the choice of stocks that you're going to invest in.
Oh, that makes perfect sense. Thanks.
So exactly. I mean, I think getting that, I mean, we might have heard that from other people, but to hear it said by somebody who is an option volatility trader primarily, it gives us a real good clue that may be a good area to look into. And if we want to are at the point where we want to get beyond, pure trading on options volatility. And he also has a bunch of earnings trades. The one he mentions is persistence of movement and after earnings, after a positive earnings event. And again, it's in his book. I won't get into it. Ron, have you gotten into any of this kind of area?
Yeah, I've done all of them. So, okay, a couple of notes. So for the first one there of essentially trading VIX futures or VIX ETPs, definitely doable, but you just can't do it based on that one line, right? So if you're going to be shorting vol when you're in contango and then going long vol when you're in backwardation, that's not a trade plan, right? So you need much more than that.
Ron, and I absolutely do not intend any of these to be in any way a complete plan.
Yeah, exactly.
Let me make that
I just want to make sure everyone's clear on it.
No. You could say that about every line in these slides, and it's fine if you do, but
yeah.
His book.
So, but in particular, when you're short vol, yeah, right. So in particular, when you're short vol, you definitely need to know when the hell to get out, very, very specifically and quickly, right? When it starts going against you. And equally, you could say the same thing for backwardation. There's plenty of circle, reversion that can happen, even like yesterday, right? If you look at yesterday we actually went into into backwardation. And let me check right now, but I'm pretty sure we're back in container today. Next central.
That's interesting.
Look. Sort of, yeah. So
yeah, I mean, all of these are extremely complicated subjects, and I'm just suggesting areas that people can look into. That's all. I mean, they have his book. It's not exactly an impossible task because his book is out there and it has extensive discussions of all of these areas. I wouldn't say extensive enough necessarily, but a start.
Yeah. For the second one, regards to factors, the stuff that's listed there really falls under the category of value stocks as opposed to the factor stuff. So value is one factor. And then he's giving you here a whole bunch of fundamentals that you can potentially track in order to isolate or choose your value stocks that you'll be investing in. But it's really one factor, which is value. In the presentation from today, he mentioned a few others. Surprisingly, actually, he didn't mention some of the most common ones, which are things like momentum primarily, or low volatility, as in historical volatility, not implied. But those are probably the easiest ones to trade, in terms of momentum and low vol. There's even some ETFs that you can trade that do it all for you. You don't have to go out and select them. They do all that selection based on that factor for you. And as a matter of fact, a whole pile of other factors. So if you do some digging on ETFs, there's probably 20 or 30 different factors that you can leverage with specific ETFs, so that they're trying to make it easier for you to invest in factors now through these ETFs. So that's something you can dig into if you want to. And the third one about earnings calls, and obviously if they've done well, then in theory that's kind of like a momentum play as well, to a degree, by then buying a call spread on the assumption that the positive momentum will continue for a while.
Yeah, I'm glad you clarified that. Okay, let me see what else I have here. Then he has a series of secondary trading strategies that he uses opportunistically, and they're some of them are buy straddles across earnings dates, more earnings trades. The selling overnight options, again, that has to do with when the options decay and when they don't on the 24-hour cycle. There are ways to exploit that. Obviously, I'm not even telling you what they are, but he outlined some of them in the book. And he also has some FOMC, Fed Open Market Committee, event trades. So it might give you some ideas. He calls, I thought it was interesting that he calls volatility positions, he calls butterflies and condors and calendar spreads volatility positions. I have some quotes coming up here, and I think we'll have some more and may generate some controversy. But he says these positions are primarily used to express views on volatility. I think that might be news to some people, or they might disagree. Would you? Ron? Would you agree that butterflies and condors are primarily volatility positions?
In very simplistic terms, sure. You could say that they're basically short vol, right? So if you put on a butterfly or a condor, and then you check your Greeks out, your Greeks will be fairly highly negative vega. So therefore you are taking a stance on volatility, right? So if volatility comes down, you make money. If volatility goes up, you lose money.
Anybody else? Yeah, thank you, Ron. Please don't let Ron and don't let me and Ron dominate the discussion too much. Okay, let me see here. I'm sending an email at the same time. And okay. Now for straddles and strangles, he has the formula that if you do not hedge, you just let the position run. And here we're only talking about the expectation not the individual occurrence, not every time. And this is also harks right back to what Ron just mentioned. Your profit or loss on a position is going to be vega times the implied volatility minus the eventually realized volatility when you liquidate your positions. Would you agree with that, Ron?
Sure. Yeah. There's also a bunch of papers on, like, if you got SSRN and so on, that you can get all these really interesting, if you're into it, fancy formulas when it comes to at the money straddles for calculating a whole pile of stuff with basic numbers without getting too deep into math or anything like that.
But I think it's quite striking that we need to be focusing on the vol. I mean, many people out there, they look at trades as simply, you get into it, you trade it. They don't, I think some of them don't even, they say, I can trade in low vol, high vol, and whatever. And maybe they can, but we need to be focusing. Does this also mean that if you have a positive vega position, that you should only be doing that? Let me put it the other way. If you have a negative vega position, you should be expecting vol to increase?
The other way around, right? If you've got a negative vega position, your hope is that volatility will decrease in order to make money.
Your negative vega, yeah, that's correct.
Yeah.
Now he uses GBM.
So,
go ahead.
Yeah. I was just going to. That reminded me of the point that you asked before, and you were kind of talking about, efficient market theory, and does it make sense to buy a put when the market's crashing and all that kind of stuff. The thing, I guess, that came to mind when I heard that is, even though this is a very simplistic way to look at it, when people talk about efficient market theory and all that, it's really more or less just saying that things are fairly priced. Right. So Euan was talking about an inefficiency in a market doesn't last long. And that's true, especially these days with, automated trading, high frequency trading, machine learning, all that kind of stuff. They can find inefficiencies in, microseconds and then try to take advantage of that. We can't compete with that. But then taking the jump to saying, since everything is efficiently priced, we can't make trades. Those two things don't kind of line up, right? So if you are in a position that you are paying a fair price for a put, which is what you were asking about, right? You're saying, if I think the market's crashing and I go and I buy a put, does that make sense if everything is already priced in? Well, yeah, it does, right? In the sense that if the market does continue to crash and vol continues to increase, then that position will make money. The fact that it was fairly priced is not a negative. It's actually a good thing that it's fairly priced, right?
Why should we suddenly need to hedge if what's different now that the market is crashing? Shouldn't we assume that it has already reached the appropriate price? I mean, this gets into almost philosophy, and it's impossible to come up with an answer. But if the market is efficiently priced, okay. Go ahead.
Yes. Well, one of the things, and I'm saying this as well from some algo communities that I participate in, but a lot of people always think that IV is always mean reverting. And that's what everybody says all the time. But when you jump to the algo trading side of things, and then you start running back tests and deeper analysis and so forth, you'll find that there's actually something called volatility clustering. Yeah, so what volatility clustering is the exact opposite. Okay, so that when you get a spike, it's not going to mean revert in this case. It's actually just going to cluster at a higher level, similar to what we saw after COVID, right? We didn't see that one spike and then we went back through to VIX of 13, right? We spiked, but then we went back and we held still at about mid-20s. That is these days even still considered normal. 22, 23 is considered normal. So the
We
environment
have
can
both
change, and you can get
phenomena. We
volatility
have both
clustering.
phenomena happening frequently. And
So what can
the
happen
aim is
then
to try
is
and
that
sort
if
them.
you, right, but if you have that initial spike, you've got a lot of the retail side of the crowd that are immediately then jumping on through to short vol trades. Do you see what I'm saying? So in other words, there's a spike of IV of whatever, even 5 points or something. VIX goes up by 5 points, and they go, ooh,
Yeah, that's right.
down day, vol spike, I'm selling it, right? Short vol trade. But then if you're moving into a scenario with volatility is actually going into a cluster effect, now you do actually have a situation that is not going to be priced so-called correctly if it does cluster, right? Because everyone is now starting to enter trades for short vol to try to kind of push that thing back down, but it goes the other way. So if you're in a scenario like that and you are buying a hedge and vol does explode, then that volatility hedge that you've just purchased can really explode in price as well, right? So yeah, just having something
I
be
know
fairly
that.
priced doesn't mean that you shouldn't be buying it.
That was Mandelbrot's originally, right? Clustering. He discovered that phenomenon. It's a very prominent phenomenon, and you need to allow for both. But it's very, very difficult to. Well, I'm seeing some of these strategies seemingly work. I mean, I don't know if you look at something like AIC or Weirdor, in which they progressively add put protection or as the market goes down. And some of those strategies are, as far as I can see, the most successful there are, at least on paper as to the results. So I can see it works, but I'm just trying to reconcile whether it should or not.
Right. Yeah. But I think one of the big points that what Euan was trying to portray here is don't fall into the trap of thinking that the structure is the key. The key is understanding the edge that you're trying to mine and then choosing the best vehicle to mine that edge. Right? So, especially for any kind of more beginner traders that were listening in today, Euan mentioned at one point saying iron condors work. Please don't go away thinking that he's just told you what the magic trade is, because it's not. What he's implying is that the odds are that you'll win 9 out of 10 of those. That's what he meant by it works, right? But then the problem is that with the one time that you lose out of 10, it's not going to be, the size of that loss typically is nowhere near what a normal win is. You're winning in small size, but then you can then take one big hit that one time out of 10, and that one loss may wipe out all of your gains and sometimes even then some beyond that.
Right. And in fact, he has that point in his book, and I have it quoted here. And it's showing at the bottom of this slide, strangles or condors will make higher median returns and a higher win percentage, but this can make it more difficult to distinguish between good trades with expected value and good luck. Confuse it with, we might say. So in other words, if you start selling a lot of condors, then you quickly draw wrong conclusions unless you're very, very careful, because your losses will be huge, as Ron just said, but they'll only be rare. And a lot of people who are in this business and traders generally, not only newbies, go around changing, their method on the basis of, a momentary change in the market, and on the basis of a few winners. You can't do that. It's wrong. Now we have here Josh Berg saying, why GBM not operable through market options with dividends, period? Referring to a reference here now. GBM, who knows? Let me have a test quiz here. Who knows what GBM stands for? Not too many takers. Josh, do you know what he know? Well, actually, I don't think so, Josh. GBM stands for geometric Brownian motion. Well, it may stand for some other things as well. And it turns out that that is the same thing as what's called a Wiener process, which fits in with a normal distribution of returns. Doesn't take into account jumps. Yeah. Josh, did you have any comments you'd like to say on the mic? It sounds like you're pretty knowledgeable. Interested in hearing any comments you have at a little bit more length. Also, while we're, let me see, well, we're almost out of time. Anyway, those are a few ideas. He does actually cover calendar spreads in his book. Okay, let me get Josh in here for a second. I'll unmute his mic for him. Josh, if I can find him, Josh Berg. There you go, Josh. You got your mic is on now. You might have to get it working. Anyway, I'll just keep talking while you're doing that. Just interrupt me, please, if you get ready. So I've highlighted some points there. He has other chapters on directional options trading, trade sizing, meta risk. I think we had a little good discussion here. Josh, any luck? Well, not yet. Right, Josh will come back to you if we have time. Okay. Ryan is going to present. Go ahead. Let me unshare, or you just take it from me, Ryan, please. Let me just see.
Sounds good. Thanks, Don. Okay, can you all see my screen?
Yes, we can.
Okay, so you see the chart of the VIX here?
Yeah, I think I've just unmuted myself.
Okay, well, just hang on, Josh, and we'll come back to you in a minute. Good, but we'll
Sure thing.
Go ahead, Ryan.
Sure. So, yeah, we talked a little bit about the VIX, and everyone's familiar with the VIX and what it is. It's basically an average of all the options and kind of comes up with a number for the 30-day volatility. And then, of course, VIX Central, which Ron mentioned earlier, he said, is it kind of in contango? Is it in backwardation? And this essentially are the futures, right? So this is the spot VIX here. And then these are the futures on that. So essentially, if you're buying a VIX future, you're trying to make a bet that in the future, VIX is going to be higher than where it is today, where this future is today when you purchased it. And so this graph here is showing more risk in the short term. For instance, in February 16th, which is when this expires, right? So this is basically showing that on February 16th, which is 30-ish days from now, or I guess a little bit less than that. So basically, that's where they think the VIX is going to be then. That's a 30-day VIX. Now, I don't actually use VIX Central when I try to determine if something is in contango or in backwardation, because the futures are one step removed from the actual options themselves on the S&P 500. I use this website instead. So this is the term structure data of the actual implied volatilities put out by the CBOE. Okay, and so here we are seeing basically the volatility is the same VIX formula applied to the entire chain, but it's applied to each individual chain, right? So here's February, March, April, etc. And you can see that this is in contango, whereas these futures over here are kind of in backwardation, right? And that's because this is 30 days removed from this right here. Now, if you wanted to see what this data looks like in Thinkorswim, then of course, if you pull up Thinkorswim, you can see over here, this is kind of the implied volatility of the various months. So these numbers here actually correlate exactly with these numbers here. Okay, so that's what you're looking at. Is basically these numbers, but in a chart format on CBOE, which is a free website that anybody can use. Now, if you looked at the implied,
I think if you hit /VIX and you go to product details, you can actually see a yield curve.
yes, you can. You're absolutely right. Now, this down here is the implied volatility that is for 30 days. So that not to be confused with these implied volatilities over here. This is a 30 days, which is actually very similar to what the VIX is today, right now. But if you were to open up these various chains, then you see an additional implied volatility. So this is like at the money, essentially, for this individual strike. So most of you are familiar with all this. This is review for everyone, but I just wanted to clear that up. And then you were saying, John, if I say slash, you say
yeah,
VX?
Josh, slash VX. So you bring up the
Yep.
future, and then if you hit product details, so you go to trade. Where's your product details?
Yeah, it's weird. I don't know.
Yeah, that is strange. On mine, I have a product details tab that either brings up my volatility smiles or gives me the option to bring up the contango curve so that you're able to view it.
Maybe I need to enable something or download an update. But in any case, I'll check that out later and try to figure that out. But I've seen that before. I know what you're talking about. So what I've done here is I really wanted to see. I want to get more. I really wanted to see this website, right? But I wanted to do more with it. I wanted to enhance it. So what I've done is you can actually go to TD Ameritrade, developers at tdameritrade.com, and you can sign up for an account. It's a free account. And if you go ahead and log in and then you go to APIs, you can come down here to option chain, right? And you can say get option chain. And this will allow you to download the option chain in JSON format. So here I've already filled it out. You basically say SPX put options, strike 37.75, and I put in the March contract, and you hit send to get the data, and this will spit out all the data in Thinkorswim. So we're not using RTD or real-time data. TOS doesn't have to be open. This is just straight from the Thinkorswim servers, and you get all this great information. Okay. So then you can actually, if you're, it's not, I'm using Visual Studio here, and I have ASP.NET and .NET Core. So if anyone's a software engineer, you know what I'm talking about. This is the Blazor format. So I created this website essentially that will show some of this stuff. So here is basically what I did is I rounded the S&P to the nearest 25-point strike. So here is 37.75, and also downloaded the VIX from the Thinkorswim APIs. And then these are the at the money strikes, volatilities. Now there's no way to actually get these volatilities over here. You could download the entire chain and do the calculation yourself, which I'm considering doing. But for right now, I just kind of grabbed these numbers here.
What do they do for those chains? Those numbers are just delta weighted, or what do they do? Like some kind of weighted average?
It is a weighted average. It's literally the VIX formula. Yeah, you can look up.
No, delta. I think it's delta weighted for their. They use the VIX formula to get their individual contract tenor IVs. Really?
I don't know what Thinkorswim uses over here. I just know that if you go to the CBOE website, you can read about how if you read down here about their methodology and their white paper.
Oh yeah, I was talking about the TOS volatilities. I think they use a delta weighted average for those. It's not.
In a lot of
it's not very
cases,
good.
In a lot of cases, they never fully disclose. Like if you look at their so-called implied move or market maker move or whatever they call it.
Yeah, it's really fuzzy. I mean, just bring
Yeah.
up like that 29 and take a look at ATM. It's definitely not 29.
Right, exactly. Yeah, it's not at all. Yeah, 28, 22. Yep.
Right? Like it's not even close.
No, it's not. So yeah, they're basically looking at all of these across the entire chain, and they're averaging them somehow.
Yep.
And I
Yep.
believe the way that they're doing that is outlined in the VIX white paper, because these numbers here like match up exactly with what you see right here.
Oh, no way. Okay, I always thought it was a delta weighted average that they were
Yeah.
taking. So it looks like they're using some VIX methodology. So probably just weighting puts and calls in some way.
Exactly. Yep.
Yeah.
All right. So going back to this. So what I've done is I trade calendars. So here is the various expirations, and this is the at the money implied volatility. The number in parentheses is the days to expiration. So these line up here with these numbers right here. And then I have basically the price of the calendar, and then how many days are actually in the calendar. So, from February 19th to March 19th, there's exactly 28 days. And but then you can see from like these dates down here, it actually will change, right? So this one has 28 days, this one has 35 days. So that's why this calendar is more expensive than this calendar. Does that make sense? Because there's actually literally more days between the contracts, even though it's shorter DTE, or it's closer in time. There's more days in it, and that's why it's more expensive. So you can kind of get a feel for what the average cost would be for a 28-day cycle, for instance. And then what's a lot of fun is you can click on this, and it takes you to a analyze graph. And let me actually go to this one instead. So this is showing the implied volatilities again, and it just shows you the cost of the calendar. And here is a you can zoom in and zoom out, etc. right here. But then what I'm showing is I'm calculating that in 30 days, right? Because I put one of these on every 30 days. This will return about a 18% profit. Now, obviously, a lot can happen in 30 days, and contango and backwardation, and it doesn't account for what happens as it goes down the skew curve. But it's literally the same thing as if you were to put this into Thinkorswim and then increase the days going forward. So this guy here, I've actually put in the special dates, so you can see. Let's see, where was it? Yeah, so the expiration dates are actually highlighted in orange. But then and you can of course adjust this forward if you'd like, and see how many days you'd have to be in to get a 40% return on your investment on average.
A lot of them, probably like a couple of days before expiration with calendars.
Right. Yeah. And then of course we got delta up here. It's kind of fun. I calculate all the Greeks, etc. So this is just something I'm playing with for fun, and it's kind of helping me every day in my trading. And then this is kind of neat too. You can copy the trade, and then come in here to Thinkorswim and go to the Analyze tab and just paste it in, and then you can just analyze this guy.
Wow.
So it's really nice. It saves me a lot of time from having to go over here and open up this chain and click and shift click, control click, whatever. I can just copy and paste.
That's really cool.
You're not offering this website, are you, Ryan?
No, this is just running on my local host.
Right.
I mean, maybe one day when I eventually get the ability, because you can do all sorts of stuff in here. You can hook it up to, let's see, you can hook it up to various accounts, and you can pull in actual orders that were placed. And so you could literally run you could see the entire trade. So you could set up a complex trade, a campaign, for instance, and you could show it here in this graph just by using the API, which would be really cool. And then of course, if I were to harvest this data every day or tie into historical data, then you could do back testing as well. That's kind of where I'm going with it.
Does that Does it take in real-time data, or is it just discrete updates, or how does that pull in data?
It is as close to real time. It literally is the same as what I see. Oh, I have this website, and so in this price for the calendar will update. So this updates every 5 minutes. This page will, or every time I hit refresh, and then but it'll be exactly what's in Thinkorswim.
Wow.
So yeah, it's real time.
If you
Nice
have,
work.
if you develop a methodology for trading calendar spreads, or if you can articulate it to any extent at all, please let me know and we'll have a, give a talk.
Yeah, sure, absolutely. And what's nice, I can sit here and just like I can just watch it go into contango or backwardation here, just watching this curve. It's kind of like watching the CBOE or VIX Central, but it's this is a little bit closer to what I'm actually trading since I'm trading at the money calendars. And then of course I got I put it into a phone app, for my phone here as well. So I have it with me everywhere I go.
What technology are you programming in?
But this is all Visual Studio.
Yeah, but what?
Oh, C#.
Okay.
Yep. And then I could go through a trade if there's time. Otherwise, it's fine. We can just wrap up.
I mean, what type of graphics framework are you using?
This is all just stuff that's kind of built into Bootstrap and Blazor. And then this particular chart is called this Radzin is the name of that chart control.
Oh, I
It looks
see.
really good.
So can you run that on the desk? Well, I guess it's web based, so you can do that.
Yeah, you can publish it anywhere. Yeah, absolutely. It's just local host right now.
And I also have a bunch of apps, but they're totally unrelated to that. They're a different thing altogether. Very good, Ryan.
Yeah. So what I've noticed is that usually around 60 DTE is a good time to get into these trades, 60, 65, something like that. And then you're out pretty quickly, sometimes as early as 45 or 40 DTE.
Conrad says he was curious what a trade would be.
So here I have one. So this one I got into on January 7th. Started off with about $10,000 in margin here. And then, there we go. And then let's see, the market kind of did nothing for a while. So I'm just going to jump forward here to the next time I put on a trade. And this is January 14th. And you can see that, the initial trade was put on right here. This is that green dot. And then here's today. So the market just went sideways. So I was waiting for it to move before I put on the next tranche, and I did not move. So I just went ahead and put it on. So now we got 8 calendars on. And then the market ended up going up quite a bit. And so here's the chart now. So it kind of dipped a little bit, and then it went up on this big up day. I went ahead and just bought 4 more, and I'm doing these in the calls. Sometimes I do them in the calls, sometimes I do them in the puts. It doesn't really seem to make a difference. Usually, if the market is below, I will do it in the calls. And if it's above where I want to put on the strike, I'll do it in the puts. But
that's good to hear, because some people were saying that put call parity was violated in these prices.
Yeah.
Did you move? Exactly. Did you move that to? Did you add? Is that an add, or is it a? Did you make it a double? Did you make it like a straddle swap, or what? What's going on there?
Oh, I just added another calendar above the market. Okay. So the market moved up to 3850. So I put my original on at 3800.
Oh yeah, I see. I see on the right.
The market went up to 3850, and then I put the next one on at 3900. So I just straddled the market.
Yeah.
And I usually stick to the 25 point strikes because they just have a little bit more volume, and I also just stick to the monthly contracts rather than the weeklies because you just get a little bit better pricing. But anyways, then we all know that the market came back down, and when that happened the other day, I went ahead and just got out of the one I just put on. a day or two prior, mainly to reduce risk to the upside or to the downside in case we just tanked. And I actually made a small profit on that when I took it off. And then my profit target is 20%. And I hit that today. So I got out of the trade. And this is what it looked like right before I got out of the trade. I know this says 18%, but if this is using closing pricing, because we haven't actually rolled over to the next day, but I got out for about, 20%. So.
Excellent. I think you should give your own talk, Ryan, when you're ready, and go a little bit slower so that people who, introduce what a calendar spread is and so forth for beginners as well. But this is excellent to understand what's been possible and impressive.
Yeah, so I got into this particular calendar at about 70 DTE, and I was in it for 21 days and made 20%. So that seems to be pretty typical. Around 30 days in trade, and you'll make around roughly 20%. That's what I found.
What was the hypothesis on this trade? Was it a low vol environment? You were looking for prices to move up and vol to move up, or what was your idea when you got in?
Basically, it's this right here. So typically, it's contango when I get in. I get in just about every month, but usually, if the markets are acting normal. If the markets are not acting normal, I'll probably just wait, right? But if the markets are acting normal, I'll go ahead and get in. And then, you can see here that if, and right now these IVs aren't true because TOS doesn't actually have accurate IVs after hours, because the after hours trading kind of messes with them a little bit. So if you were to take like a snapshot at like 3:30, for instance, or 4 o'clock, these IVs would be better. And during real-time hours, they are better and more accurate.
Yeah, they don't align. The options close at a different time than the underlying.
Yeah, they're open for 15 more minutes. But in any case, like I said, if you get in around 60, 65 DTE in 30 days, you can expect to see about 20% profit, and that's just where we are right now with volatility today. If you go back a few years when volatility was much lower, you would not make as much profit. So it's a good time to trade calendars. And the hypothesis is just what you see. It's the pricing, basically you're buying this one and you're selling this one, right? Or you're buying this one and selling this one, and then 30 days go by and all of a sudden it looks like this, right? So the one that you bought,
that's one vol point though. Like you're selling it for one vol point contango. I mean, you're looking for vol to perk up in this trade, no?
Well, you want, if volatility does, we've done several talks on calendars here, and Mark, if he's on the line, he can probably explain it much better than me. But when volatility does, you actually don't need volatility to spike. In fact, you don't want it to go into backwardation.
I get that it's weighted, but for differential, we're talking about one vol point here, yeah?
Yes.
Okay.
Yep. Yeah, so the idea is the one that you sold is going to decrease in value faster than the one that you bought. That's the premise.
Yeah, that makes sense.
Thanks, Ryan. Josh, did you have some comments other than this?
Not on this, other than what I saw in terms of the program, it looks really incredible. I'd love to hear some more insights from someone who trades calendars.
Yeah, but let's not dwell on calendars solely. I mean, what did you think of the whole? Well,
we were just talking about calendars. I thought that's what you were referring to. If you're asking about Euan's talk, I thought it was was really great that you were able to find an author of that caliber to come join this talk. I really enjoyed everything that he said. It was great. I would have liked to hear him speak a little bit more about, from a professional standpoint, how he's tackling volatility, the volatility curve, and how he attacks the smile with a little bit more specifics. And also just in terms of what his viewpoint is and his vantage point is on smiles. Like a lot of the volatility curves that we're looking at through some of these platforms isn't really representative of what what volatility is. It's not really designed for what we're viewing in a lot of respects. And it also would have been interesting to hear a little bit more about some of the dynamics as to when he sees how the smiles are going to evolve over the next little while, or based on what they've been doing for the past little while. For example, with equity curves with a notable call skew, how he's reacting to that and how he's tailoring, for example, risk reversals in order to take advantage of that.
Yeah,
I
that's
think it was
right.
Ron that posted a chart of a risk reversal. If you take a look at that chart, you can see there's two triangles, one big, one small. That's edge. As that bends, you can imagine that's what gives you your edge, provided that you have it the right way around and your timing is good. But I would have loved to hear from the horse's mouth exactly how he would like to time that, how he what type of a blowout and what type of a bend in that smile he's looking for in particular in order to work that edge.
How do you trade in that area?
Yeah, I trade risk reversals quite often.
Or you do trade risk reversals? Oh.
Yeah, I do. I trade risk reversals quite often. In terms of commodities, I mean, typically you look for those things to blow out. It's mainly an FX trade. If you take a look at any textbooks or you talk to anyone who's ever traded FX, the risk reversal is the main thing that they're looking at. If you look at the Bloomberg terminal, it's quoted in you have your risk reversal, your butterfly, according to your 25 delta, etc., all quoted. Those are the quote specifications. So every trader is looking at those types of things in a balanced skew environment. With commodities with a forward skew, it's a little bit different, and then with equities with a back skew, it's different. And of course, nowadays with a call skew and equities, things are completely unbalanced. So it's
we need to get into a lot of those areas, and we will. If you wanted, can you join our group or send me an email? I'd like to stay in touch.
Yeah, for sure. I've joined your group, and I sent you an email a little while ago. And I've attended a couple of these talks, and I really like what you guys are doing. I think it's quite incredible.
Great. Thank you very much for those comments. And I'll check for that earlier email. I'm sorry if I overlooked it. And anybody else have any? We have to go. We're at well past our time. Anybody else have any comments or final other points to raise?
Can I leave you with a final thought? Is that all right?
Go ahead.
You're probably not going to like it, but I'll say it anyway. And put it this way. Actually, let me put it as in terms of a question. So what was the main edge that Euan is claiming with that trade that he showed, which was a hedged risk reversal? How did he describe the edge that he's mining?
Oh, is that a question for me?
For anyone that wants to answer.
I don't, let's not spend a lot of.
I think, well, Ron, I could tell you that from experience trading those, and I think that, I mean, you're the one that posted a diagram. You could probably see from the diagram as well. If the skew bends back, it provides you with a small lift, and that lift provides you with padding for theta decay, such that you're able to take advantage of the directional trade.
We can't get into a long discussion. And Ron, is that the general ballpark? You're looking
not exactly. All right. So let me put it this way. So and I'll try and be brief. The way I'm just referring to the way that Euan described it, not your opinion, Josh, but
sure.
The way that Euan described it was that puts out of the money are priced higher than calls that are out of the money. And he actually described that as an edge, which actually surprised me. Because in my opinion, that's actually not an edge. It's just a way things are.
I totally agree with you. And
right?
That's exactly what was going through my mind.
Right.
Okay.
Because that's always the case, basically, right? You go to SPX out of the money puts are always going to have a higher IV than out of the money calls, always.
Okay.
So
okay.
Yeah.
Fine. Thank you.
Yeah.
Anybody else have any final points? If not, we'll thank everyone for joining us and for what I thought was a very rich discussion. Thanks to Ron. Thanks to Ryan as well. And we'll end it there. Thank you. Good night.